Welcome back to the channel. My name is Brad. Today we're going to discuss a video that was put out last night with an interview with Jay that runs the options trading or is the supervisor for Yield Max and Defines Funds, and he talked about Roundhill. There was a lot of things said in this interview that got glossed over. Literally just, I didn't know, nobody wanted to challenge him, but you got glossed over. Let's talk about weekly distributions, Jay. Not your keys, not your crypto. You want to get my comment on this? Take off third-party risk out of your perspective and guarantee me that I'm going to get my money back. Oh, well, you can't do that, right? So, not your keys, Jay, not your crypto. Most of us are a little more high-risk players in this field. A big sting like FTX. FTX was talking to the SEC a lot. SEC is not going to help us, ladies and gentlemen. So that's my 2 cents on weekly payouts. Not in my bank account, not my money. So take that to the bank. Really, the bank. Anyway, leverage. Jay threw out leverage yesterday, and it just got glossed over. Roundhill uses leverage. Okay, Jay. Roundhill uses diagonal calendar spreads, right? So yes, diagonal calendar spreads, or what's called a poor man's covered call. They're able to sell more calls on the funds due to they have more availability. It's not leverage as you and I would go to Fidelity and take out a leverage account and take an extra 10% loan against my money. That's not what they're doing. What they're doing is doing a poor man's cover call where they're buying a call deep in the money. And this is the video that I took down because I made a mistake of a zero. It's 90% in the money, and there's a risk to that. All right, so United States is going to zero. Thanks, Jay. Appreciate that. Boast of confidence about leverage. The next one is, and what he said here is what I want everybody to go listen to, about minute 9, gap up. This is exactly what I have been talking about basically from day one. Yes, gap up. The difference between market close and market open. Jay was right on the money on this one. So that is my response to Jay. Now, I am going to go listen to the rest of his video that he's talking about how they're changing this things and how they're going to be able to write different calls on some of the Yield Max funds. I think that's an interesting strategy. I really, really wish, and this is just me speaking out loud, and Jay, if you're watching, I would love to see a fund that you have a lot more ability to write a lot more different styles of cover calls. Just throw it out. These funds are literally strangleholding. We're going to write a cover call this way. We're going to do this. How about call spreads? How about collars? How about... Okay. There's a lot of things that Jay could do if the funds says that he could do it. If it's actually in the prospectus and actually approved, I would probably invest in something like that. I think Jay's a very smart man. I think Jay is getting his hands tied a little bit on how he can write calls and how he can do things. And Jay, if you ever want to come on the channel and get challenged a little bit when you say things and maybe asked, what do you mean? Feel free. I'm here for you any day. Please bring it on. I might challenge you a little bit more than just, oh, they use leverage. Oh, yeah, and moving on. No. Let's explain what you just said there, because that's a good one. I am going to put a link down below to somebody I follow on Seeking Alpha. He explains this also in his most recent post of how they use their synthetics. I don't follow everybody on Seeking Alpha, but I do follow this person. He's technically sound. So if you see him, I would highly recommend following him and reading his commentary, because he does a very good job of breaking it down to the layman's. If you want somebody that you can read and actually understand what they're saying, he's one that I would follow. Secondly, this article brings up another market risk for the Roundhill funds, and I'm going to let's throw it out as something I did not think about, and that is if there's a price decay without an increase in the VIX. Just to say, do I think that's ever going to happen? No, I don't think it's ever going to happen. I think it is out there. I just don't think, usually when there's a market decay like that, there is a increase in the VIX. But if not, then we would see capital erosion without any additional gains in premiums, and that could affect us long term. Roundhill announced their distributions this week, warned you that everybody was piling in to QDTE, and that caused a significant drop in what we're actually getting paid. QDTE is about 31 cents, just over 31 cents. And XDTE, 38, almost 39 cents. This, I'm going to just say, you should be playing both fences here. Notice I'm playing both fences. You should be playing both fences. Maybe a little less in XDTE, but you should be playing both fences here. And as you can see on my chart, you can see that, hey, everything's on QDTE is now coming back to the mean, that 38%. That is why I'm doing it 3 different ways, to show you, hey, 38% is probably more the floor than the high side, but I want to know where the floor is. XDTE averages are slowly climbing up. Another great distribution. I'm going to get $611 this week. Just going to say I can live nice with $611. Keeping in mind, this is only a very small portion of my portfolio. Please do not put all your eggs into one basket. Diversify. Tons of funds. I've already covered some of them. I'm going to cover more. I'm going to have another video today covering a different single stock ETF. Diversify, everybody. Diversify. Yes, have these in your funds, but do not put all your money in there. Secondly, just throw this out because I've seen some people come to me and say, hey, look at my portfolio. Hey, you have 3 stocks with the same underlying. Are you betting on Bitcoin? Are you betting on Bitcoin? Try to limit yourself to 2. And if you really want to retire like that, just buy Bitcoin. Just, okay, sorry. It irks me that I'm going to put all my money into 3 funds, and all 3 funds have a really huge underlying tie to Bitcoin. You're putting your retirement at risk. Now, 2 of those I actually like, and I don't want to say, hey, I would ever recommend it, but 2 of them I like. 2 of them, I'm challenged and deep inside, challenged of not buying them, but I'm going to stick true to my world and stay with my indexes because I am at that age. But if I was in my 30s, I might take a little more risk. And we'll cover that later today, actually, in the fund that I'm going to cover. In Jay's response last night, or in his video last night that he was in, he talked about gap up. When we look at these charts, you can see gap up. When we had a recovery really quick, we did not have a lot of market movement during the day, but between close and open, we did. And that's what we captured. The problem that we got into is once we quickly got back up, gap ups ceased to exist, or they existed, but they were smaller. And as Jay alluded to, so what we saw was gap up. So the S&P 500 gap up was more significant than the NASDAQ. That's why the S&P 500 XDTE caught up way quicker than QDTE because their gap up was more significant. If you've been watching for the last week or so, the NASDAQ has been opening very sluggishly. The gap up has been smaller. That is why we're seeing QDTE not catch up back up to pricing, is because of that gap up delay. I ran a back test for the last 5 years. At the end of the video, I'm going to share this back test. What I found was we shouldn't be overly worried, but there is some market in there. When we look at their strikes are being consistent. They're consistently winning, consistently losing, back and forth, but they've always been very close. I enjoy that. I think that they're doing good calls. I'm not going to bang anybody. Since I used to write calls, you can't win every single day, but they have been doing very good with their calls, right? Especially, I want to say with XDTE, QDTE, they're going off that little bit more premium. XDTE, they seem to be a little more conservative, and that might just be market play. When I look at my research, you can see the green being the Russell 2000. There is a lot of gap ups, a lot of gap downs, there's a lot of market movement, but overall, the market in this strategy moves up. Now, I came up with the NASDAQ was going to be closer to 50%, 53% in market movement, where that's only half of what actually the market moved in the last 5 years, even less than half. So we're not ever going to gain what QQQ gains in any given year. So if you say, oh, it's not keeping up to QQQ. Yes, it's not keeping up to QQQ, but QQQ is not giving me 30% yields, 40% yields. Last week it was almost 60% yields. That is the difference. we're never going to keep up to the market. So please, we shouldn't even be comparing ourselves to QQQ. Now, I'm going to go ahead and throw out, I'm generating the burger rule. Again, out to Oracle. I've looked at so many funds now, doing so many back testing because I actually have the time, that I'm seeing repeatable, actionable patterns that we could use. Especially right now, if you're 5 years out from retirement, there is definitely a rule that you could use with most of these funds. Yield Max, Round Hill, I'm going to make these rules so you can just apply them. Right? They're not foolproof. This isn't financial advice, but these rules will get you to the point that you can really live off of these distributions. But for my retirees, those that actually want to use it now, I'm going to have to come up with a different set of rules, and I'm literally working on that. So when everybody's asking me questions or sending me emails, yes, I know you're important, but I'm trying to get out a set of rules for everybody and not just an individual. So I'm going to get to you. 6 hours of analysis yesterday, not 30 minutes, not 2, but 6 hours sitting here back testing, running Monte Carlo simulations, running other simulations. I'm going to get there. I'm going to get you a set of rules, guidelines that will get you to where we all want to be, doing something other than listening to the man every single day. And we'll get there. It's a lot of these funds have possibilities, right? But we just need to use some rules and use some common sense, because people just want to put all their money into Yield Max and I'm going to live off these dividends forever. Just no, that's not what you should be doing. But if you have time, 5 years, then maybe you have something going on. That is this week's video. I know I've ranted again, but until next time, God bless.